Welcome to HCTV. You're now rocking with your boy. metldex Futures, why it stands out. The futures contract from MCX offers a good tool for portfolio diversification. The metldex, a futures contract from MCX with its iComdex base metal index as the underlying index, which is based on 5 base metals: aluminum, copper, lead, nickel, and zinc, is a good tool for portfolio diversification, say market participants. Naveen Mathur, Director, Commodities and Currencies, Anand Rathi share and stockbroker, says, as per various studies, inclusions of commodities in a portfolio to an extent of 10 to 15% results in better risk adjusted returns. metldex futures would meet this objective. Investors who all the while had only bullion, can now also have base metals. metldex futures can fill a void in the Indian market in the absence of base metals ETFs, says experts. Here's a look at the 5 features of metldex futures. Low correlation with equity and bullion, considered the period 2016 to 2020 till September 2020. The correlation between the base metal index and Nifty 50 on the basis of returns is about 0.13 only. Further, the metldex futures have low correlation with gold too. During the above mentioned period, the correlation between the MCX metldex futures and MCX bulldex futures on the basis of returns has been approximately 0.145. Per MCX data, the correlation between metldex futures and MCX gold futures is 0.09. Cash settlement in metals futures, if a trader keeps the position open during the delivery/tender period, the last 5 days of the contract, it will be marked for delivery. In metldex futures, however, there is no such threat. Besides, without delivery, the associated costs such as delivery margins are non-existent. Delivery margins are usually 25% for a copper contract of a lot value, 13,000, 25,000 at current prices. For instance, the delivery margin to be maintained in the tender period will be 3,000, 31,250. Also read, low cost. The contract value is about 6 LAKH, 12,000 X lot size, which is 50 units, and the initial margin works out to 50,000, to 60,000. This is far cheaper than trading a lot of single metal futures. A copper futures contract with a lot value of about 13,000, 25,000 at current prices will have an initial margin of 1,000, 22,400. Likewise, a zinc futures contract with a lot of about 10,000, 30,000 at current prices will have an initial margin of 1,000, 15,875. Thus, the initial margin of metldex is comparatively less. Break even in 2 ticks. A 2-tick movement will provide break even, i.e. cover the cost for the trader. Let's explain this. Cost of trading for a member includes CTT, stamp duty, and SEBI fees. MCX is currently not levying any transaction charges. With metldex value at about 12,000 and a lot size of 50 index units, the cost of trading is about 75 to 80 for a contract value of about 6 lakh, which is 6 LAKH. 12,000 times 50. With lot size of 50 index units, 1 tick gives a profit of 50 and 2 ticks 100. Thus, a 2-tick movement will cover the cost of the trader. That was just a little insight on the metldex futures. And like I said, check it out. You can go on Google and it's metldex futures, and it'll tell you why it stands out, showing you the different metals and what they're worth out there on the open market. and the trading between metals like gold and zinc and all of the stuff, the aluminum, lead, nickel, copper, and it shows you the diversification. So go ahead and look that up. Thank you for listening. We're out. Deezy.